Welcome to Honest Money, your best guide to financial freedom. I'm Warren Ingram, the author of a few best-selling books, and I'm also an award-winning financial planner, and I've helped thousands of people on their journey to financial freedom. I'm not here to tell you what to do, but I am here to share my experience and the best ideas that I've learned, and I hope these ideas help you on your journey to financial freedom. Welcome to another really great episode of Honest Money. I'm really keen to have this conversation because it's, I think, fairly topical. We're going to be talking about how you stay invested, or what you do when you are an investor and markets are falling and markets are going down and everyone's getting panicked and scared and nervous. So I thought there isn't a better person to speak to about this than one of my long-term colleagues, Yolande Botha, who heads up the wealth business for Galileo Capital, and Yolande specializes in helping high-value investors actually to do exactly this, to get invested and to stay invested for long periods of time in all market conditions. So I thought, who better than the guru? So now we've got the guru. Yolande, thanks so much for joining us on the show.
Thank you, Warren. Thank you for that compliment.
So I think when we start with investing, it's a really nice journey when you start with someone and you talk about how you're going to build their plan and how you're going to roll out their investment strategy, and that's usually a lot more fun than the conversation, whether it's in 3 months, 3 years, or 3 decades later, when you've got to talk to them about their investments going down. And what they should be doing or not doing. So I thought, it is topical. We've been dealing with this for years now, but I think especially since COVID, I mean, it's become, a part of our lives, these big volatile markets. So what is your experience in dealing with investors in these kinds of conditions?
Yeah, absolutely, Warren. And I think it does start with a plan, and when you actually start your investing journey with someone. Markets are volatile, and what we do know is that we are going to have recessions in any period of time. And markets go down by quite a lot. So it is to prepare people to know that there are going to be times when they lose money. But it's one thing to know it and, in a rational way, and one thing, and another, totally another, to feel it on an emotional level. And it's only when you've got money invested and you're going through a period like this where you feel it and where the emotions come into play. And then usually what we tell clients, or what I tell our investors, is that we knew this is going to happen. Valuations were very high, markets go into recession, so this was going to happen. And the first question I get then is, so why don't you take us out of the market? Why don't we go into cash? And that is possibly the worst question, right? So the thing with markets that's down is that hindsight is 20/20 vision. And the market is forward-looking. So if we did that, if we started changing clients' asset allocation, so you in equities and now suddenly we decide you have to go into cash, the probability of us getting it wrong is extremely high. If we look at what happened last year, it was very volatile. The news were bad, and we would probably have gone out, say, in the middle of last year, and clients would have lost quite a bit of growth that happened in the last 6 months of last year. And it's only in the beginning of this year that markets went down. So you probably are, in the South African market, you're actually still up over a year period. And if we went into cash, you would have been down.
Amazing. And I think that's maybe the thing about market timing, which is, this is the crux of this. It's such a intuitive concept. It's such an easy thing to understand once markets have done what they're going to do. As you say, hindsight is always in favor of market timing. The reality of market timing is you've got to make 3 decisions to be a great market timer. You've got to decide when to buy. So you've got to buy assets when they're cheap. Then you've got to wait for them to rise and get expensive. Then you've got to sell when they're still expensive. And then you've got to wait for them to get cheap again. And then you've got to decide to buy. And my own experience is that people can be fairly good or fairly reliable in terms of deciding when an asset is cheap, and they can be reasonably accurate in terms of finding an asset when an asset is expensive. But it's that last decision. It's to say it's gone from expensive and it's become cheap again, and now is the time to buy. And that third decision is where professional and private investors seem to trip themselves up time and time again. And I agree with you. I mean, I think if you're going to practice market timing as an investment strategy, the likelihood is you will lose a lot of money and enormous amounts of stress along the way. And someone who just rides out the markets ends up being, as you say, I mean, if you look at it over a year, you've had this huge roller coaster ride, but actually you're still up and you've done nothing. You've incurred no taxes for capital gains taxes. Yeah. You've got no transaction fees. So emotionally, a much better ride, and probability wise, you have a much higher probability of making money by not doing something than actually taking action.
Yes, absolutely. Now, in times like this, the best thing you can do is sit on your hands and maybe don't look at your investments for a while. There's so many articles and research done on losing out on the best days in the market. And there are studies that shows you if you've lost out over a 10-year period, you lost out on the 10 best days in that 10-year period, that your money would be half of what it is, if you just stayed invested. And that's a huge loss to take.
It's crazy.
And I looked at what the best days were, two of the best days, and one of them was in October 13, 2008, and the market jumped by 11.6%. Now, that was a very scary time. It was the global financial crisis. Banks were falling apart. The financial sector were going nowhere. We thought it's the end of the financial world. And we had the best day. In March 2020, middle of COVID, when the markets really were down and very volatile, we had a 9.4% day. Now, if you were out of the market and you missed that day, so are you going to get back in after that? And then you've lost a huge chunk of growth already. How do you get that back?
Yeah, absolutely. And I think we're not that good as humans and as an industry to know exactly when that best day is going to arrive in the bottom of a horrible market, because it's usually a completely emotional reaction. It'll be, I can't remember exactly why the market jumped in that COVID crash, but it will be something like the American Reserve Bank saying, we're gonna support the markets, or there's a piece of research that says all the vaccines are working, and if we get the vaccines into arms, we're going to end the crisis. It's going to be something that's a piece of news that you can't predict, that's going to force the markets up like a rocket. And if you're sitting on the sidelines waiting for things to get better, you've just watched the markets give you 10% that you didn't participate in. It's a horrible thing to miss out on.
Yeah, and it's hard to get that growth back, if you were in cash at that time. And recessions can also last for a long period of time. I think people would, after the last one, would think that it is much shorter, because during COVID, it was probably the fastest downturn in the market and the fastest upturn again. But they can last for years. So just to keep that in mind, and that you still, and when it becomes longer, it becomes more difficult to stay in. When it's a quick drop and it lasts for a few days, and then you see some volatility coming back, so markets going up and down, and suddenly it starts rising, it's a much better ride to have than this long, drawn-out thing where it's just going down all the time, and you're just seeing your capital, it goes from 10% down to 20% down to 30% down, depending on your asset mix, and depending on the markets where they go. That's hard.
So I think you brought up a phrase there I do want to talk about is around asset mix. So maybe if you could just expand on that, and what are you looking at when you're talking to investors about asset mix, and what do they focus on? What should they ignore?
So it starts with your financial journey, just to make sure what your goals are, whether it's a short-term or long-term, but we're talking about long-term investing here. And then the risk profile of your client. Now, the risk profile encompasses about three aspects of it. So the one is your own tolerance. What risk can you take? What what would you be comfortable with? And comfortable, I'm saying with um, inverted commas, what do you call them? Those things.
Yeah, those things, yeah. Inverted commas, I think you're right.
So, because no one's comfortable when a market falls, right? So, but will you be okay if your capital is down 10%? Or can you only manage 5%? And will you stay invested in those times? That's really what it talks about. So, and the other one is your capacity for risk. Do you have enough money? Do you have an emergency fund? Do you have other capital available to you so that you can handle lower markets, where your money is down 20%, say? And the other one is, what kind of risk do you need to take to get to your long-term goals? So sometimes you need to take a higher level of risk than what you would be comfortable with for your money to grow enough for it to handle your long-term goals, or for you to get there. So what that means then is, for some people, and usually younger investors, you can be 100% in equity or shares. That's your most volatile asset class, but it is the one that will give you the highest growth over long periods of time. Another client might only be comfortable with about a 25% drop in their assets, and they need to be in a balanced kind of portfolio. So that means that you have to have shares, but you also need property, bonds, and a little bit of cash to manage the downturns. And just to put that in perspective, markets are down 18% year to date, and balanced portfolios are down about 9%, so half of that. So that's the kind of protection you get when you add cash and bonds and property to your portfolio. But then, of course, on the upside, you're going to get a little bit less of the growth than someone that is 100% in shares. But it's to manage emotions, and it's that thing to try and keep people invested. It's much better to stay invested over long periods of time than to get someone in just 100% shares with the highest growth, but they're going to climb out of the market when markets are down. So that would be a mistake.
Just on that, when you talk about a balanced mandate, so typically your allocation to shares, it's not like you've got a 5% allocation to shares. I mean, you're talking about a 60 or 70% allocation to shares. And your real world example there is that, by having 60 or 70% of the stock market exposure, and then the balance in cash, bonds, and property, you're losing half of what everyone else is losing by being 100% in shares. That's a massive difference. I think that, and I think it's important to land that, because when markets are doing really well and FOMO kicks in, and everyone's worried about missing out on the rising markets, then they'll gladly take 100% of their money and go into shares, because they don't want to miss out on that extra 2 or 3% of growth per year that they would get from purely being in shares. But I mean, your example there is powerful. That actually take a little bit less exposure to shares, get most of the growth of the stock market, and when times are bad, and this is one of those times are bad now, you're only losing half of what everyone else is losing. And I think that's a powerful way to stay invested when you're worried about markets, you've got money in, and you're looking around and everyone else is panicking, and you're saying, well, I'm okay. I've only lost half of what other investors have lost.
Yeah, exactly. And I think for a few investors, even 65% usually sounds like a high quantity to have in shares or in a growth asset. And especially in markets like this, where you should be going in, it feels a little bit uncomfortable. But pension funds, just maybe to talk about that, they can go up to 75%, and that's still a very prudent kind of asset mix to have, where you've got lots of protection in your capital.
Yeah, exactly. And I think that's an important point as well, is that, 75% feels, to some people who don't understand markets, that will feel like a huge amount. But actually, if that's what a pension fund is allowed, and they're paying out income to pensioners, then it gives you a nice perspective that actually that's not a ridiculous allocation to shares at all.
No, and it gives you good protection still in markets like these.
So I think we are already out of time. I think we're actually blown our time already. So such an important and I think relevant conversation. So thank you very much for joining us, Yolande. And I think just to summarize for people who are invested now and seeing markets go down, the trick there is make sure you've got the right mix of assets, that right combination of cash, bonds, property, and shares. Make sure that when you invest, you are investing money for long periods of time. And long periods of time are at least 5 years and longer. It's not 5 days or 5 weeks, it's 5 years and longer. And then lastly, you've got to make sure that you try and protect yourself from making market timing decisions. You can't go into this thinking, I'll just chop and change my investments when I see things changing in the markets, because actually what you need to know is you're going to get it wrong. Everybody does. It's not a reflection on you. It's a reflection on the entire markets and how crazy they are and how quickly they can turn. So if you can do that, those are probably the 3 keys to being a successful long-term investor. And we heard it here on Honest Money from one of the gurus. So Yolande, thank you so much for joining us.
Thank you very much, Warren.
Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @Warren Ingram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.